All right. Hi, everybody. My name is Richard.lesperance. I go by the name of my man Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have Douglas Carpenter with me. Douglas is a CPA and a CFA, and he's going to share with us some insights in regards to tax savings. So, welcome, Douglas, to the podcast.
Thank you for having me on.
It's my pleasure. All right. So, what are some tax deductions or tax credits that business are not aware of?
I think what a holistic approach has to be taken towards tax planning. It really starts with the type of entity that you have. You may want to consider, switching an entity or doing things. It depends on your financial situation, how your family is situated, what your tax bracket is. It's a very, very comprehensive type of planning. A lot of people look at it as a kind of a one-off. They'll do a 401k plan, or they'll do IRAs, and they understand those well. But there's actually a lot more to it, as anybody who's done deep tax planning is aware. There's trust. There's all kinds of ways of managing income. I'll give you an example. Let's say you have children in college. And you're trying to get financial aid, and you earn too much to get that financial aid. Having a C Corp as opposed to, say, an S Corp or a partnership could make a very big difference. Why do I say that? Because a C Corp can retain money that doesn't get charged to you. The C Corp pays tax on it. You don't. That doesn't get included in your income. Whereas a pass-through entity like an S Corp or a partnership will pass through to you. So it's a way of deferring that income into other years, maybe then qualifying you for financial aid. One example of 100 different things that we look at for someone who, it's for individuals, but mostly we work with people who own their own small businesses.
Okay. And what are some other correlation between personal, like for your personal taxes and business?
Is the thing that you have to look at is, as an owner, how are you being taxed? What advantages can the business bring for for you, as opposed to just you personally? There's really three silos. It's what the business can save, it's what you can save, and then it's combining the two, which is more complex, of seeing what advantages are specific within the way you've set your business up. I'll give you an example of someone who has a business, uses their car for business, and the advantage there is to lease the car through the business. They can't write off 100% because they do use some of the car for personal. We are able to distinguish that and get more of a write-off. These are very simple things. And I think most business owners do it, but it surprises me how many don't. We come across businesses that are not doing that. Pass-through entity tax is another whole different thing, whereas you can pay your state taxes through your pass-through entity. It allows you to get a credit on your personal tax return for that. I would assume every business owner is aware of this. That is incorrect. I have business owners that made probably about $2 million each, two business owners together as partners. And we're unaware in New York City, which is the highest taxed place in America, unaware of this. And so we did this for them and saved them over $100,000 each just by that one tax move alone.
On a higher level, how does that, because yesterday I was listening to some videos in regards to taxation with businesses. How does it work on a high level for people who take equity instead of taking a salary?
Basically, it's a good move if you're in a higher tax bracket and you want to defer. There are rules with compensation and how the value of the equity you receive. You receive it in stock, though. There are ways of managing that, and again, you can defer income. There's also, on the other side, there's ESOPs that you can offer your employees, which is a way of having your employees participate while you are able to get money out of your business and essentially sell it in pieces to your employees. So there's a lot of different ways to look at that.
Correct me if I'm wrong. You were mentioning in one of your recordings that there are new credits out there. You talked about you mentioned about the R&D. Talk to us about that.
The R&D credit actually is not new at all. In fact, that's been around for decades. And it's what it allows you to do is write off the full. First of all, you can write off the full amount, but of your credit. But your increase in R&D expenses can get you a credit on your return, an actual tax credit. That's one way of it's one of the types of credits that we work on. There's a federal R&D credit, and also many states will copy the federal, so you can get both a federal and state tax credit.
So what about the 401ks, RA, and HSA?
Sure. These are all pretty basic plans, but they're important, and they're something every business owner should be involved in. With a 401k, there's employee participation. What we look to try to do is maximize the contribution that an owner can make. It's up to over $70,000 a year in that can be contributed under a maximum, but most business owners may not qualify for that maximum. There's less because you have to have a certain number of employees participate and so forth. But a 401k is definitely a good option. Another thing is if you have a spouse that can contribute to that business, maybe work for that business, you could put your spouse on and put money into their 401k as well. And that's one way of extending and increasing the amount that you can get contributed as a couple into a 401k. And HSA, I think, is one of the best things that you can do. These are health savings accounts. There are some restrictions and some things you have to have in place, but most people, it's not that difficult. You have to have a high deductible health plan in order to go into that. But you can deduct thousands of dollars every year, depending on whether you're single or married or have a family plan that enables you to, similar to an IRA, put money away. And in the future, it's tax free if you use it for medical expenses. You can use it currently, or you can save it in an actual account, even in a mutual fund or something like that, and use that in the future. It becomes sort of a retirement planning. As we get older, our medical expenses increase, and it's a great way to plan for that. And I think people should do that every single year. I have clients that have hundreds of thousands of dollars in their HSA. And what's great about it is as they age, that money is there for all their medical expenses.
Do you recommend in regards to the legal structure, do you recommend sometimes people to change the legal structure for tax purposes?
I do. There's a lot of different circumstances. It's not a very common thing that I recommend. It really has to have some major tax advantage or a particular reason. What I see more of, though, is having different types of entities. So most business owners are serial entrepreneurs. They open a business, they open another business, and then a third business. And you may want to have different corporate structures for each of those businesses, depending on what you do and how different those businesses may be from each other.
Okay. And in regards to investors, people who invest in stocks like full-time or day traders, what's the rule for them? How does it work?
There's a fairly high bar you have to establish to be considered a day trader. But if you do reach that bar, it's certain work requirements, the amount of hours you put in. But if you do, there's a lot of things that you can write off. It's similar to a business. It becomes a business. So you can write off your computers and your time and things spent. If you have a home office that you do out of, you could qualify for a home office deduction. There's a lot of things you can do as a day trader if you do qualify. But again, it's not something that you could do, have a job, do casually, come home, do it for a couple hours and call yourself a day trader.
Mhm. What roles do trusts or holding companies and family offices have?
Well,
Let's start with the trust.
yeah, the trusts, I mean, they're very complicated. There's a lot of different types of trusts. That would be probably an 8 hour webinar I'd have to do in order to just cover it in the right way. And I don't want to give any kind of legal advice. on that. But trusts are something that people should look into for particular purposes. So, for instance, a charitable trust may make sense to somebody. That's where you put money into a trust for charity. You basically will retain control of that money, but you get a deduction for your charitable contribution now. But the money ultimately does go to a charity. There are estate ways of using a trust for estate planning. That's a particularly common use of a trust, and a way of ensuring that money that you have, a wealth that you have, is properly handled. There are revocable and irrevocable trusts. The taxation of each is very, very different. Irrevocable trusts have their own taxation, whereas revocable trust generally falls under your own tax. Trusts are also, people need to be aware that a regular trust, just the way it is taxed usually in the highest bracket. So it's not a way to escape taxes. It's a way to plan around taxes. So, you're probably not going to get a reduced tax if you don't have a purpose for it. So there needs to be a purpose with that trust. That's one of the important things.
What about the holding companies?
Holding companies, we often see, if you have a business, and there's a lot of different reasons you would have a holding company, but one of the most common I see is real estate holding companies. Say you have a restaurant, and it runs, and you own the building as well. It would probably be best to have a holding company that's separate from the restaurant. The restaurant will be taxed one way. The real estate company as a holding company will be taxed differently. And you can, by charging your restaurant a competitive rate of rent, it creates a reduction in income, a reduction of your profit on the restaurant, and moves it to the real estate holding company, which is appropriate, again, as long as you use normalized rates that anyone else would pay, nothing inflated. But these are ways that businesses use to move things around for tax advantages.
And the final one, family offices.
Family offices is where that's really not a tax planning, it's more of a management structure for investments. So if you have high net worth family or concentrated net worth, they may have a family office all to themselves. There's also a lot of family offices that will do multiple families. What they do is they bring in expertise in all different individual areas. So in a typical family office, you'll have a legal expert, you'll have a tax expert, you'll have an accounting team, you'll have a business management team that actually runs the business. Most family offices that I see are somewhere in the $50 to $100 million plus range. Whether they're doing it as one particular client, they may have one family that's in there, or it could be multiple families that add up to that amount of wealth. But it's really a family office is a management tool.
What about, so if you were to prepare like just an example, a tax planning for an entrepreneur, what would that look like?
The first thing I would do is get their, find out more about their business. If they haven't started yet, we would make a recommendation of the type of entity. We often work with their lawyer as well to do that, to make sure we've got everything in the right way. We would look at their personal tax return, and we look at what they've done so far, where they are in their life cycle, where they are in their investment cycle, see what they've done, and plan around that. So they may already have a well-established, IRAs and other things that they do every year. That's great. They do the HSAs, but then we'd want to see get a 401k start up. There's also a 401k tax credit they can receive for starting a 401k in their business. Also, a lot of states, depending on the size of your business, now have it mandatory. You have to have a 401k for your employees. So these are all the things that we consider going in. We'll look at the structure. We'll look at your personal. We'll look at where you're going. Do you intend to sell this? What's your exit? Do you intend to sell this business in 15 years for 20 times what you paid? You may want to set up a C Corp because there's huge tax savings when you sell on a C Corp for qualified small business. You can get up to $10 million of gains tax-free in that type of business. An S Corp, a partnership, you can't do that. A C Corp you can, but there are disadvantages to having a C Corp as well. So that's all the different things we have to weigh. Usually what happens, I'll sit down with a client and I'll explain all the options. Then I'll give a recommendation, but I want them to understand all the options, what the pluses are, what the minuses are, and so that they fully understand it.
What would make someone or a business pay more that they should pay usually?
Lack of knowledge of the tax code is the reason. I can say this that I have yet to have anybody come to me that I didn't save money. It's never happened. Even small tax returns that come in, I usually spot something. But most businesses, I would say they're overpaying their taxes by tens of thousands of dollars, most businesses, because they're unaware of the ins and outs of the tax codes. They are extremely complicated. They are always changing. And not only do you have the federal, but you have the states. And that's another area. I mean, sometimes we get a business that's in a state I haven't worked on. I have homework to do. I have to go in, but I know where to look and what to look for and how to discover what those credits are. There's a lot of states out there that I'm well familiar with: California, New York, Connecticut, etc. But every now and then I get someone from Nebraska or Kentucky, and it's a little less known, but they still have a tax code that has to be followed.
What are some upcoming changes in the tax system?
Well, we had the one big beautiful bill that just came out, and that's done a lot of things. I have gotten so many questions on how that affects businesses. The good news is, in a lot of instances, it doesn't. It's kind of business as usual. In other ways, there are tax credits and things, depreciation that you could take, that you were able to write off in the past, that are coming back, that you can do that again. Accelerated depreciation that was starting to phase out. But there's always different things, and it's something that I literally spend hours each week, looking at what's coming down the line in legislation. Because the tax planning I do has a little bit of a catch. It's not just today. I mean, a lot of it has to do with today. It's also anticipating what the tax code will be tomorrow. So there's a little bit of guesswork in it. It's not a perfect science. And one of the important things is to know not just the legislation, but what is Congress thinking? They may not pass it this time, but these things have a habit of reappearing over and over until they do pass. And so it's not enough really just to know the tax code, but you have to know what the potential changes to that tax code could be.
They say that tax bill is mostly for the rich. Is that true?
There are advantages. It's a tough question. It does. First of all, you have to pay tax in order to benefit from a tax cut. So people with low income are not going to benefit from a tax cut. Wealthy people are going to benefit when you have a tax cut. The idea behind it, yes, there are some things in the bill that I think fairly should have been different. But for the most part, or I'd like to think that the tax code is focused on growth and ultimately increasing the revenue to the government. So you get, say, accelerated depreciation. You're allowed to depreciate 100% instead of writing off over 5 years or 10 years. What does that do? Well, in theory, and often in practice, businesses will invest more. They can get the write-off right away. They don't have to wait. So they'll invest more. That stimulates the economy. That causes the economy to grow. Ultimately, there's more taxes derived from a growing economy.
So what would be your last words in regards to everything that we talked about?
I would say in last words is if you haven't had comprehensive tax planning, you should look into it. Anyone with that's relatively in a higher tax bracket, maybe 25% or up, should definitely look into it as from an advisor standpoint. I think that's where most people miss out. And the biggest thing I get, and I get this from some of the most sophisticated investors, is why didn't the guy who does my taxes tell me about this? I get that all the time. And I have to defend them. And that is, did you engage them to do that? Be careful, because when you go to get your taxes done, that's all you're doing. You're getting your taxes done. You're not getting planning. You're not getting advice. If they throw that in there, that's wonderful. Good for them. But that's not what you engage them to do. You engage them to actually do your return, do it based on the information you gave them, and that's that. Deep planning and other stuff, you have to go out and get and seek that.
Where can people learn more about you and follow you?
I appreciate that. We can be reached. I could give my phone number if anyone would like that. It is 718-412-2570. You can look us up. We are solutionsbychs.com. That is solutions with an S, by BY and CHS, Charlie Henry Samuel.com.
Last question. I have a few minutes. I just wanted to add something. Uh, some industries have uh, tax breaks, like special tax breaks, whether it's real estate or other industries. Why is that?
Well, there's the energy sector is a big one. There's a lot of different breaks out there. It's to stimulate that area of the economy. Basically, they're put in specifically to grow and encourage growth in those particular sectors.